Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Zendesk. Somebody reached out to me and said, oh Michael, can you tell me your thoughts about Zendesk? So I kind of went through, and it's a bit of a mixed bag. It's quite cheaply valued, which kind of is quite attractive for me as an investor. So it's clearly growing, and one of the blemishes that people kind of feel is that it's not that profitable, and I get that, but I don't think that there's a reason to kind of skew this investment just because of that. So let's just go through here, okay? So, I mean, everyone is talking about us being in a tech bubble. Man, I just seriously don't see that. This stock is down more than 30% in this year to date. So that clearly, correction territory. So, I mean, it's one of those things people just like to say stuff, but it's just a few names that are really just making the whole averages go higher, because underlying that, a lot of these small cap names, not small cap because it's approximately, with the Momentive acquisition, it's going to be approximately 16 billion. So it's not that small, but it's kind of, there's a lot of household names that are trading really, really expensively. But as soon as we kind of come off those names, there's a lot of stocks that have really gone nowhere in 2021. So, as I've already alluded to, the stock, what has dramatically held off the stock from going higher is their acquisition of Momentive for approximately 4 billion in an all-stock deal. So that's one of the main things here that's really overhanging. But as you go through here, Zendesk as a standalone business, they were pretty much growing at in the mid-30s to even reaching 40% CAGR before the pandemic, and then the pandemic hit and they decelerated. After all, this is a customer-facing business, so as you can imagine, anyone that was going through a bit of a hard time would have tried to get off any kind of surplus customer software, and that has impacted it in 2020. But coming into 2021, you can see that acceleration, and in fact Q3 21 reported a few weeks ago, they were up 32% year over year, and that allowed them to marginally increase their guidance for the year as a whole, so that Q4 21 is going to be growing at approximately 31% year over year. So for all intents and purposes, this is a company that as a standalone business is growing at, let's say, at approximately mid 26 to kind of 28, kind of in that ballpark, okay, as a whole, okay? So it's a reasonably rapidly growing SaaS business, okay? Now, they had the analyst day a few weeks ago, and they're saying that together with Momentive, as a business as a whole, they're going to be compounding at 27% between now and 2025. So they're going to reach approximately 4.6 billion in revenues, okay? So when all is said and done, it's clearly a business that has enough visibility, and they're growing, at a substantial rate. It's not growing like some of those other stocks that we've that are priced at bananas multiple, but it's clearly got enough under its engine to keep growing, okay? One of the things that I find quite interesting here is that the dollar-based net retention rate for Q3 reached 122%. That implies, and you're going to see in a minute, that their ability to land and expand customers, particularly to grow as the customer grows, is really what's driving here the top line in revenues. Because as you see here, and I'm not sure if you can see properly, but the customer logos since the early starts of the Q1 21 been churning out slightly. So, as I've often said, the most important thing that you want to see in a business is a growth in customer base. It's nice to see the net retention rates being high, but you really want to see mass appeal with customer adoption rapidly growing, and you don't see that here. You see, I know it's up year over year, but sequentially it's kind of like tailing off, and that's really something that kind of puts me off from this investment. Now, the analyst day points that finishing 2021, they're going to be approximately 7.5% operating margins. But going out to 2025, including Momentive, which is a business that's not as profitable as Zendesk, they're going to be at approximately 15% operating margins. So it's growing, let's say, at approximately 27%, and it has a non-GAAP operating margin of approximately 15%. So once you add in the stock-based compensation, they're going to be approximately break-even for some time. So that's part of the issue here. And that's part of the reason why investors are kind of like, okay, yeah, this is underwhelming really. It's not really something that's that exciting to get involved with. Now, everything comes at a certain price, right? So 7 times forward sales. I was thinking to myself, I don't know so many businesses that are SaaS-based that have clearly strong net retention rates where the stock is priced at less than 10 times forward sales, okay? Because, I mean, this is quite cheap, really. If you think of it, there's many businesses that are growing at, let's say, in the mid-20s. I can stream you a name of them, and they're all priced at approximately 15 times forward sales, 20 times forward sales. You can look at I don't want to kind of drop any names because it kind of distracts people to say, oh, you know, that's not a direct competitor to XYZ. But if you think about it, I compared here with ServiceNow. So ServiceNow is priced at approximately 18 times forward sales. Now, ServiceNow is obviously a much bigger business, but their growth rates are also, you know, they're not coming that fast growing anymore. So it's probably going to be growing at approximately 20% CAGR. On the other side of the equation, you got to say, okay, yeah, but ServiceNow has free cash flow margins of approximately 30%, and their guidance for themselves for 2025 is also reiterating that. So it's a business that has been consistently growing in the mid-20s. It's expected to kind of come down. The analyst day kind of points them to tail off to about 20% CAGR, but its free cash flow margins are really, really high. So yes, it is priced at 18 times forward sales, so it probably does reflect a large part of those high free cash flow margins. But then you got to think that in the case of Zendesk, I mean, it's not growing that slow, you know, 27% CAGR is pretty reasonable, and you're just paying 7 times forward sales. I mean, it's pretty attractive. One of the things I like to always check just to see if I kind of want to get involved in the stock, the CEO right now owns less than 3% of the stock. If I look back to 2018, he owned 3.3% of the stock, and management team as a whole owned nearly 5% of the stock. So they've been kind of selling off, partially because of the stock-based acquisitions partially because of the stock-based compensation has led to some of their holding being diluted out, but they don't have so much incentive as they did in the past to grow to see the share price going higher. They are aligned, but it's not really like some other founders that are really positively incentivized. So it's kind of a mixed bag, as I highlighted. And I've said before, and I'll say again, when you look to invest, don't try and go for things that are 50-50 chance of working out favorably, or don't even go for things that are 60-40% chance of working out favorably. Try and go into investments when the valuation is so screamingly cheap that there's a 70% chance of working out favorably. And that's exactly what I try and look for in my marketplace. So don't forget to check out Deep Value Returns. You can see what other people have said in the reviews for my service. And yeah, I hope to help you, making you a better investor. Okay? Thank you so much, everyone. Thanks.